Hello, I'm Andrew Mellor. Thank you for joining us. With me today is Portfolio Manager Min Zeng of the Fidelity Japan Equities Fund, and we're going to discuss some of the reasons why investing in Japan is an attractive opportunity right now. Thank you, Min, for joining us.
Thank you very much for your time.
Japanese equities, very interesting part of the market. We've seen deflation, mostly flat returns for really the last couple of decades, until more recently, where Japan has been far more in focus among investors. Can you please tell us some of the structural factors and governance improvements that are leading to Japan being a more attractive investment destination for investors presently?
Sure. I think corporate governance improvement is one topic that's a focus right now. One thing to mention is this path of improvement is not something that suddenly started recently. It's been a decade-long journey since corporate governance code, stewardship code introductions into Japan, improving board structures for over the past decade. Today, what's really changed is, I think, it's kind of impacted by COVID or instigated by COVID, the return of inflation and what we think and corporates now think as a structural inflation into Japan. That is changing the mindsets of companies that used to hoard cash and under deflation, which was somewhat logical, to actually finding opportunities to deploy that cash, whether it's into growth opportunities or, if not, returning it more to shareholders. That kind of discussion within the market between investors and corporates is much more active now, and companies are much more willing to act at this point in time.
Okay, very interesting, thank you. Min, so many investors have been underweight Japan equities for a long period of time. What are some of the areas in the Japanese market that may be appealing and attractive for global investors particularly?
Sure, I think especially with the recent change in the dynamics of the economy, and a big part of that is inflation, there are some sectors that clearly didn't benefit from deflation in the past and is now changing. One of them could be financials. The trajectory of the Bank of Japan's monetary policy, that has been shifting, and we expect that to continue. There are also very traditional unattractive sectors like construction, where pricing power is returning to the industries and the companies that are operating and the entire supply chain within this sector because of rising capex demand in Japan, declining labor supply, and companies' ability to just charge more for new projects. Of course, there are always interesting stocks within the consumer sectors. That's an area where you can really pick winners and losers. There is a question in Japan now where if we are finally reaching a positive cycle of wage growth above the rate of inflation, how does that drive the next phase of consumption? Because until now, it's only been the relatively wealthier, where the consumption has been strong, and then a trade down of the general consumer into lower priced products. So how does that shift? And of course, there's always the sectors that are heavily globally competitive and impacted by the global economic cycle. Those can be robotics, semiconductors, automotives. There are always opportunities in those sectors to invest along specific cycles.
And just on that point, do you think this is more of a short-term opportunity in Japan, or some of these improvements and reforms are actually more medium and long-term?
Sure. It's definitely medium long-term. The meat of the improvement is medium long-term. Short-term, we've seen, as the market has revalued, the market is pricing in the change in the corporate mindset. The corporate's willingness to address this balance sheet that has been too strong, returning excess cash to shareholders, etc. Medium term, what happens from here is corporate Japan restructuring underperforming businesses. That will drive a level of margin expansion of corporate Japan to drive earnings per share of the market itself. Eventually, as businesses shift into higher ROIC, structurally become higher ROIC, as they shift their business portfolio, the market kind of valuation itself could reevaluate further. But that is a medium-term kind of outcome as companies execute on their plans to restructure.
So in terms of timing, is this a good time for investors to consider a dedicated Japanese equities exposure? We saw some volatility and market sell-off in sort of July and August. The market recovered quite strongly from that. Is now a good time to consider it? And also, what sort of environments is your fund likely to outperform or underperform the market?
Okay. It's always a good time to think of investing. Volatility provides opportunity, usually. That's what I'll say about exact timing. I think the Japan market in general and for the fund, a good environment for this fund specifically is if we've been through a period of global industrial slowdown. If we begin to see a reacceleration of growth, of especially the industrial cycle, while inflation remains, still intact, that level of inflation is higher than what we've known in the past, especially for Japan. That's an environment that is better for the fund.
Okay. And maybe just to close around some stock examples, I think most Australian investors will be most familiar with some of the autos names in Japan, the electronics names in Japan, but maybe a couple of stock examples that you're currently holding in the portfolio as examples for us, please.
Sure. So the top sector that the fund owns is in construction. I'll introduce two names. One is a very boring general contractor called Obayashi in Japan. This is a company, it's a sector I mentioned earlier that is benefiting from a really repricing in new projects as demand is strong and companies are short on supply. So it's a very typical, strong demand supply situation. We see multiple years of margin expansion driving earnings. The stocks in this sector, and particularly the one that the fund owns, is not priced more expensive than the market. It's in line or slightly cheaper. It has a very high dividend yield. And so it's a stock that I think will do very well in terms of fundamentals, regardless of macroeconomic cycles. A second stock is called Sumitomo Forestry. Now, it has nothing to do with forestry, really. It does own some forests in Japan. Its main business is U.S. new single-family home construction, which represents about 70% of its earnings. It is within top 10 supplier of new homes in the U.S. It's a 7-8 times PE, 4% dividend yield stock, a value stock where the fundamentals of its business really improve if the interest rates in the United States come down, driving the housing cycle. And long term, we have a positive view on the U.S. housing demand, given the supply shortage versus population growth that's happened over the past decade. So that's another stock that the fund owns.
Okay, no, thank you very much for those two excellent examples, and thank you for your time today, Min, and thank you all for joining us.